Good evening, everybody, and good morning, good afternoon, wherever you are. My name is Rainer Tuss from UBI Lab Leeds, and I would like to welcome everybody to our online webinar, How Can We Pay for Universal Basic Income? Is Sovereign Money the Solution? Our main speaker will be Geoff Crocker, and Malcolm Sawyer will be commentator and critic of the concept of sovereign money and modern monetary theory. Both Geoff and Malcolm are economists by training. Geoff has worked as consultant and economic advisor in many different countries, such as Russia, Kenya, and Ghana. Malcolm is a retired professor of economics from the University of Leeds, with a special interest in macroeconomics, macroeconomic policies, and the financialization of the economy and society. You will find more information about both speakers in the chat. And I would like to remind everybody that we provide a respectful space where critical and civil questions are encouraged. However, we will not tolerate any disrespectful comments. We have a chat section for comments and questions, and I would like to ask everybody to put a cue or question in front of their question, so it makes it easy for the moderator to find the questions in the chat and separate them from comments. I would like to inform you that our event will be recorded and published online at UBI Lab Network YouTube channel for further use. In case you have any concerns about the recording, please raise them now or send me an email. You can find my email address actually in the chat. The organizers of this event are UBI Lab Network and UBI Lab Leeds, which is part of the wider UBI Lab Network, which is an international network. And I'm personally coordinating the UBI Lab Leeds, and I would like to thank the UBI Lab Network and especially Johnny for the technical and publicity support of our event tonight. Our common goal is the advocacy and achievement of a basic income for everybody. Therefore, we call it a universal basic income. Our reasons to advocate for a universal basic income are several. At the moment, we experience an apocalypse of polycrisis on our planet. Apocalypse actually doesn't mean disaster, but it means revelation in the Greek language. And our revelation is about economic and a political system which is failing most people, and above all young and future generations and people living in low and middle income countries. And what has this revelation to do with basic income? System failure requires system change, in our opinion. The introduction of a basic income in society is a structural system change. Basic income can help to address the many crises in our world. And Sandhya Anatha-Rahman has created the appropriate phrase for it. Basic income doesn't solve every problem, but it makes every problem easier to solve. And money is power in our society. And universal basic income would mean money for everybody, and therefore a dispersion and redistribution of power in our societies. I will now briefly introduce the concept of basic income and why the question of funding of UBI is so important. The concept of basic income has been defined by the Basic Income Earth Network, also called BIEN, and you can find the web link again in the chat. First of all, basic income is a periodic payment of cash at regular intervals, for example, every month or every week. It's not a one-off grant. It's a cash payment. It's paid in an appropriate medium of exchange, allowing those who receive it to decide what they spend it on. It is not therefore paid either in kind, such as food or services, or in vouchers dedicated to a specific use. It's paid to the individual and not, for instance, to the household, which is a big difference to our actual social security systems, which are almost all paid the sort of support to households, assuming that it will be equitably or equally shared in the household, which is obviously not often the case because of power differentials in households. The basic income is also universal. It's paid to all without means test, and it's unconditional. It's paid without a requirement to work or demonstrate willingness to work. However, it's not supposed to abandon work. On the contrary, basic income will enable people to work without losing the basic foundation for essential needs. Now, funding and costs of basic income are a big issue. It has often been argued by opponents of basic income that basic income is a very good idea, but it's too costly and cannot be afforded by society. However, cost, in my opinion, is not an objective and neutral criterion because cost can be analyzed from different perspectives. I argue that the cost of basic income from a societal cost perspective is almost zero because money is just redistributed in society. And this is different from health services and education, where the money is actually used for the purchase of resources such as labor, equipment, and consumables, and therefore cannot be spent on other social goals. However, in basic income, it's just a redistribution of money. The funding of basic income is important because universal basic income can be funded in different ways, and this will determine whether people will support or reject the idea. And one option of funding is sovereign money, which we will discuss tonight. And all the different options of funding have to be assessed in terms of public acceptability, ability to raise sufficient funds to finance an adequate UBI for everybody, who will lose and gain in society through the funding of a UBI, because one aim is to overcome poverty and give everybody a safe foundation. So we do not want to turn people into more poverty through the funding of a UBI. And what is the political will and feasibility of a specific funding approach? If UBI is funded through taxation, we need to consider the role of taxation in society. In German, the word for tax is Steuern, which also means steering. In my viewpoint, taxation for UBI should steer society in a direction where certain behavior is encouraged and other behavior is discouraged. Funding of UBI can also be done through levies instead of taxation on the so-called free use of our different commons, such as the air, public space, nature, and the legislative system. Tonight, we will learn and discuss the funding of UBI through sovereign money, which is based on the state as the creator of money through the central bank. I will now pass on to Geoff Crocker to explain his concept of funding of UBI through sovereign money. Afterwards, Malcolm Sawyer will give his response, and then you will have an opportunity to comment and ask questions. I suggest that you keep your contributions limited to about 3 minutes so that as many participants as possible can contribute and ask questions. I hope you will enjoy our webinar and learn from it. Now, please, Geoff, start your presentation and then pass over to Malcolm. Thank you.
Thank you, Reinhard, both for that introduction and for setting this up. I'm just setting up my screen now. Can you see that screen share, everyone?
Yes.
You can?
Yes,
okay,
yes,
good,
thank
thanks.
you.
And thanks to everyone for coming, and look forward to an interesting discussion on this question of, can we pay for universal basic income by sovereign money? So some opening remarks. First of all, the presentation is work in progress. It's a development idea. It's not a concluded position, and I'm not making a presentation in kind of, didactic lecture form. It's an exploratory presentation. My thoughts on central bank practice extend from what currently is the case in central bank practice and definitions to what current practice is necessarily the case, whether it's necessarily the case and could therefore be otherwise. In my diagnostic, I regard financial balances and cash flows as intermediate variables in the economic system, not as fundamental constraints. And the methodology that I'm using is based upon an analysis of the real economy and not just accountancy of the financial economy. And therefore, my definition of affordability will follow Keynes' statement that anything we can actually do, we can afford. So, some thoughts on the nature of money. First of all money is initially created. It's either created as metal coins or as paper notes or as digital tokens as it has evolved through those media. And it's interesting to note the seigniorage on that money, that is the difference between its face value and the cost of its physical production, is limited in the case of metal coins because they actually do cost the metal. And in certain periods, in fact, metal coinage actually had a negative seigniorage, i.e. the value of the metal in the coin was greater than the face value of the coin itself. And I don't know whether any of you read Benjamin Meyer's lovely book, well, not lovely, but a moving book, The Gallows Pole. But at that period of time, people were shipping English coins over to France, melting them down and selling the bullion because it had greater value. But as you go into paper notes, the seigniorage becomes higher because the cost of the paper, even though it's security paper and holographed and so on, is less than the metal in the coin. And ultimately, digital tokens that we're now used to give a very high seigniorage because they have pretty close to a zero marginal cost of production. Other questions about money: is money backed up, as people see it, by question gold reserves, as was thinking 100 years or so ago, that the money had to be backed up by a mineral that we dug out of the earth? Now, today, we regard that as a pretty ridiculous idea, but it was orthodoxy. And it was an orthodoxy that only disappeared in the last century. Is money backed up by a so-called bank IOU, i.e. it says on the bank note, I promise to pay the bearer. But what is the bank promising to pay the bearer? If it's a £10 note, they're promising to pay them another £10 note. So actually, that's pretty tautologous as an idea of being backed up in any way. The MMT view is that, the Randall Wray view is that it's backed up by its acceptance by the authority, the government, to pay tax. The view of others, and this would be my view, that money is backed up by its acceptance to buy goods and services. That's what gives it credibility and confidence, because it refers to output GDP. The other point I'd make, and again, all these points are still exploratory, is that there is an ongoing evolution in the theory of money. It's not as though the theory of money is a fixed point. There's evolution, there's development, there's challenge, there's debate. So stage one of the evolution of the theory of money is pretty well done, i.e. the shift from the so-called multiplier theory, that banks are intermediaries, that customers of banks put their money into savings accounts, and the banks realize not everybody will want to withdraw all at the same time, so therefore lend out a famous multiplier of the deposits that they've got. And that theory of money, again, was pretty orthodox. Certainly in the first part of the 20th century, right up to, in some cases, very recently, if you consult economics theory textbooks. So the point, and that's mutated over to and morphed to the credit theory of money, i.e. that commercial banks create money when they make a loan either to a business or to an individual. And you'll find that both on the Bank of England website and in a nice article I found recently by Andrew Hook at Sussex University. So the evolution of money theory is ongoing. And as I pointed out above, the 100% seigniorage that now exists on digital money gives those commercial banks huge profits because they are allowed to create money in that way. So stage two of the evolution in the theory of money, which is what I'm exploring, pushing for, thinking towards, is work in progress. And it is from a view that government expenditure is equal to debt to a view of debt-free sovereign money. And I'll explain how I think that could come about. So the system of government funding, as many will be aware of, is that governments are currently prohibited in most jurisdictions from direct money financing of their expenditure. That's true in the US, it's true in the UK, it's true in the EU, and it's true in Japan. So strangely enough, we have a system where private commercial banks can create money, but neither governments nor central banks have the license to create money. So governments fund their expenditure by a mixture of taxation and borrowing. The borrowing in the UK is managed by the Debt Management Office, DMO, who sell government bonds to traders in the primary bond market. And that includes pension funds, insurance companies, stockbrokers, and foreign central banks. There appears to be no objective limit to this level of debt. It's pretty arbitrary. There is no objective limit. So in the Maastricht Treaty, countries were supposed to sign up to have no greater than 60% debt to GDP ratios. Strangely enough, that rule is only applied at the moment to low-income countries, as I'll go on to show. So Japan has 265% of its GDP as its debt, and most developed countries have a debt to GDP ratio in excess of 100%. So this is clearly a non-repayable debt. mean, how can an economy possibly pay back 100% of its GDP, or in the case of Japan, 265% of its GDP? That's not credible. So my claim is that it's not credible to regard it as debt. But then what happens in the secondary market is that the central banks, and again, this applies to the Fed, to the Bank of England, to the ECB and the Bank of Japan, buy these bonds in the secondary market from those traders in the primary market. So this ends up in a situation where central banks hold large amounts of government debt to the tune recently of 875 billion in the UK. But second point there, these central banks are owned by the same government. Or in the case of the Fed is required to pay any surpluses it earns to the US Treasury. So the claim is this is equivalent to zero net debt between the central bank and its government on both the interest and the principal. The important argument there, if this has any credibility, is that this is actually no argument for austerity because it's zero net debt. It's de facto direct money financing of government expenditure. So what is not supposed to be happening, what is officially prescribed, I'm claiming, is actually happening by the back door, by the central banks buying the debt in the secondary market. The implication of this is that the intermediaries in the primary market are making huge profits at zero risk. And my claim that that's scandalous and could do with a good bit of investigative journalism. Final point there, that cash, which is okay, only 3% of money in the economy, when that's created, that is not accounted as debt, even in the present system. So the question about funding basic income, I think this was a quote initially from John Kay, that UBI is either too small to be meaningful or too large to be affordable. So I looked at these funding options, which Reinhardt quickly ran through for us. Revenue neutral options, that you introduce higher tax and you replace other benefits, and schemes by Stuart Lansley, who I was with yesterday, Malcolm Sawyer and others, do propose pretty well a revenue neutral funding of UBI schemes. They have the benefit of overcoming the conditionality of present welfare benefits, but they don't address other dysfunctionalities in the economy. People propose a wealth tax, but many wealth taxes have been introduced and then withdrawn by jurisdictions because they've just proved too difficult to manage. You know, there's a large range of assets by which people own their wealth. And the Resolution Foundation report on UK wealth showed how very much of it is in houses and pension funds, and therefore not capable of being made liquid. It could be somebody's got a yacht, somebody else has got money in their bank. So wealth is held in so many different ways. Land tax, the problem in my view, is that the most profitable companies in today's economy, the FANG internet companies, actually use very little land. We're no longer in an agricultural economy. And so they would end up paying very little tax despite having huge profits. The problem for me with an eco-tax is that eco-taxes should be designed to reduce pollution and emissions and not used as a source of revenue. So a sovereign fund investment, as in Norway, requires one of the above, which I think will have critiques and weaknesses against them. Therefore, we come to sovereign money creation, which is a more heterodox change of paradigm. So here are 5 reasons why I suggest basic income needs debt-free sovereign money. One is, I think it's the only way to deliver adequate basic income at affordable cost, breaking this challenge that UBI is either too small to be meaningful or too large to be affordable. Secondly, it is a consistent argument for debt-free sovereign money as for basic income. So I refer to a thought experiment, and in this thought experiment, there is a totally automated economy. In other words, a machine is plugged into the earth and all goods and services are automatically produced without any labor, therefore without any wage being paid. Now, in that thought experiment, how would the goods and services be distributed to the population? Well, only by the government distributing vouchers each year, the vouchers being handed in for the goods and services, and then the next year, a fresh set of vouchers distributed to the population. Now, in that thought experiment, 100% of the GDP becomes basic income. And 100% of the GDP also becomes, quote, debt-free sovereign money in these vouchers that are issued. So the claim would be, if total automation produces total UBI and total debt-free sovereign money, then partial automation requires partial non-labor income and requires a partial creation of debt-free sovereign money. The other is that the pilot that we were unfortunately dropped into by the COVID pandemic did act as an unwanted, but nevertheless, a pretty convincing macroeconomic pilot of basic income. Okay, it wasn't universal, it wasn't unconditional, but nevertheless, in that scheme, we paid £24,000 a year to 3 million people at the gross cost of £69 billion, all of which was funded within the BOE's, the Bank of England's purchase of 875 million of government debt. So the scheme of funding basic income by debt-free sovereign money does meet these twin objectives of getting income to people, which is a dire current need, and getting debt out of the economy, which is another dire current need. And it uniquely addresses wider dysfunctionalities in the economy of crisis, austerity, poverty, and inequality. This is the comment I was making earlier about debt to GDP ratios and the difference between developing countries and developed economies. So on this graph, at the y-axis is GDP per capita, i.e. income, and along the x-axis is debt to GDP ratios. And you can see that all the low-income countries there, which are forced to maintain low debt to GDP ratios, actually have very low GDP per capita. And the argument would be from that on this curve, for example, if you've got less than 60% debt to GDP, you've got a GDP per capita of less than $5,000. If the debt to GDP ratios goes to 60 to 80%, you've got a GDP per capita of $10,000. And if your debt to GDP ratio is over 90%, you get a GDP per capita of over $30,000 per person. So what's going on here? And could it be that debt should actually be higher in these low-income countries, or be redefined as debt-free sovereign money, paid out as a direct basic income to consumers to generate economic growth through effective demand? So this clearly does involve us in further thought on redefining the nature of money, rethinking the definition of money in the economy, rethinking the concept of affordability, and taking debt as a constraint out of the system. So we're moving from financial orthodoxy, where money determines outcomes, where, according to orthodoxy, money has inherent value either from gold reserves or the sale of government bonds creating debt, where money is real, can't be created or destroyed, where government budgets must balance, and where household and government expenditure become debt financed and therefore limited by debt. So affordability is defined by government financial reserves, to a more heterodox theory of money, where money has no inherent value. There is a magic money tree, but it derives its value from its reference to output GDP. The sovereign state can issue money against that GDP without creating debt. Currently, when a sovereign state does create money, it is accounted as debt. The question is whether that is necessarily so. Household and government expenditures then get funded by sovereign money, and affordability is defined by the real productive potential of the economy, following Keynes's comment that anything we can actually do, we can afford. There are different definitions of sovereign money out there at the moment, sometimes in debate, sometimes in just pretty hostile arguments, unfortunately. But the MMT definition, the best rendering, which I think is in Stephanie's book, The Deficit Myth, is that sovereign money funds job guarantee. And that's how they originally developed their sovereign money proposal within MMT, because they wanted to fund a job guarantee. But for them, money creation must be matched by debt creation. So Randall and Co. still think that money is quintessentially debt. And this debt for them is balanced by surpluses in other sectors of the economy, the personal sector and the overseas trade sector, fulfilling the requirements of the Wynne-Godley identity. And they then put in a zero interest rate to create no revenue financing costs. Another definition from my colleague Joseph Huber is that sovereign money becomes a state monopoly. So his proposal is that commercial banks are relieved of the ability and the license to create money, which is then all lodged with the state central bank. And in Joseph's view, that would eliminate crisis. My definition's rather different to that. In mine, sovereign money would fund aggregate demand to fulfill full potential output GDP, but the money creation is debt-free. It's not matched by debt creation. So this avoids excessive consumer and public sector debt, therefore avoids crisis and austerity. It eliminates the intermediary arbitrage I spoke about earlier, so reducing the financialization of the economy, and it returns seigniorage to the state. And there's a little table summarizing those different definitions. And from an academic perspective, the view that money is not debt is well expressed by Michael Kumhoff, who is Director of Research at the Bank of England, had 12 years at the IMF, in his paper, Central Bank Money, Liability, Asset, or Equity of the Nation. So there is a contemporary debate and a significant, substantial intellectual debate on whether money is debt at its point of creation. So we ran some macroeconomic simulation projects with Cambridge Econometrics, and there's their report on the macroeconomics of a basic income, but it was funded by debt-free sovereign money. And we essentially, this is a very well calibrated model of the UK economy used by very many government and intergovernmental agencies. And we put in an assumption that £100 billion of basic income would be introduced into the economy funded by an exactly equal £100 billion of debt-free sovereign money. And the question was, would the economy collapse into hyperinflation or devaluation, or would it produce a stable equilibrium? And the answer was that a stable equilibrium came out of the simulation runs. And that was because initially the basic income sucked up excess capacity in the supply side of the economy. And then beyond that, it stimulated investment and further production. And in fact, the second simulation run tested an automation hypothesis. So we just assumed in a very rough scope way that 15% of labor waged income was withdrawn from the economy and replaced by a further basic income also funded by debt-free sovereign money. And once again, that scenario produced a stable equilibrium. And that report's available online at the link there. We are currently working with a second Cambridge University team who have developed a stock flow consistent model of the economy with a specific financial sector, i.e. it's sort of godly compliant, if you like. And they will be asking the same questions. If you put into this stock flow consistent model with the explicit financial sector, what happens when you put in 100 billion of basic income funded by 100 billion of debt-free sovereign money? So that's due to report later this year through a combined group from the IPR Institute at Bath and the Cambridge team. And finally, more on this from my book, which I can present without any conflict of interest because I get no royalties from it. But Nick and Pierce and Bennett Normick have kindly endorsed that. So I hope that's sufficient to kick off the idea and lead to some debate and discussion. Thank you.
Yes, thank you very much, Geoff. That was very interesting and I think enlightening for all of us. So I just want to pass on to Malcolm to give us his response to the ideas and proposals of Geoff. Thank you.
Okay, thanks. I'm just, I hope that's sharing screen okay. I prepared a PowerPoint which I think has 26 slides in it, so my rule of thumb is that it would take me at least half an hour, but I'm not going to do that. I'm just going to pick out some of the points from it. But if I think the PowerPoints will be made available afterwards, which sort of flesh out some of the arguments I am putting. Okay. just now having difficulty getting. Oh, okay. Okay, the first point I want to make is that I think we have to look at UBI in terms of what might appear to be a balanced budget sort of approach. That is, that the increases in tax revenue would need to balance the increases in expenditure due to UBI. So that's a net increase in expenditure, of course, after allowing for any payments being replaced, such as universal credit. And making that calculation in terms of what would be the effects on the economy from UBI, of course, are rather difficult. What would exactly be the changes in the tax revenues and changes in the expenditure? The one would try to take into account sort of possible sort of stimulating demand effects, the effects on people's work attitudes, and effects on people's stress and health and so on. So a whole lot of it would make the calculations very difficult. Now, I'm not arguing this in terms of an argument for a balanced budget. I think I spent the last 40 years arguing against balanced budgets, or indeed most other fiscal rules. So, but it's an argument that UBI itself would do little to change the scale of budget deficits which governments any time would judge appropriate. Now, if I were the Chancellor, I would be setting a budget deficit which would be compatible with full employment. And I will indicate what that is in a little while. But if I was Chancellor already, there wouldn't be any room for increasing budget deficit because I would already be operating at the highest level to secure full employment. But not many people share that view, but so what I'm arguing is that we have to look at UBI in terms of increase in tax revenue to balance increase in expenditure on the basis that the fiscal authorities would not do little to change the deficit which they would feel appropriate. So I think in the next part is I think we have to, I partly may want to discuss what we mean by money, but I would take money to be a general acceptable means of payment, which in our society means in general, what is acceptable in private transactions is current accounts with banks plus cash and notes. For government, the government has in some sense its own money. That is, it of course pays, in the past would have paid in cash or notes. Now typically it will call on its account at the Bank of England and make a transfer out of that bank account into ultimately the payee's bank account. But the difference distinguished between paying and funding is that to pay, in order to pay for something, you have to have the means of payment. So you have to possess money in order to make the payment. And that's money specifically, and that's not using money as a euphemism for something else. It's money which is the accepted means of payment. Now, funding is to look at, in effect, taking our overall expenditure on one side of the expenditure side, and what on the other side is contributing to that funding that expenditure. So in individual cases, it would be, in our own case, it would be something like, well, our wages and salaries and dividends and pension, in my case, that we receive, plus loans that we may have been able to take out and savings which we may have been able to make or draw upon. So here, I just give the example of buying a car. When you pay for the car, we would do so through the use of debit card or bank transfer or something similar. The funding for a car would come from our savings, our making loans, maybe trading in and so forth. Came from. So as Geoff indicated, money, of course, can be produced at now virtually zero cost. when government spends, it in effect uses its account at the Bank of England. The government pays for its expenditure by reducing its prior balance with the Bank of England and by drawing on overdraft facilities. So in a sense, although I think Geoff mentioned this idea that government cannot directly money finance its expenditure, in fact it does. The example of that was particularly during COVID. In March 2020, the government agreed with the Bank of England that they would have an overdraft facility at the Bank of England amounting to £100 billion, which would be paid off by, if they used it, would be paid off by the end of the year. But that was monetizing its expenditure by overdraft. Now, the spending by government obviously leads to an increase in the bank accounts of the recipients, and the bank's an increase in bank reserves, that is the reserves held by banks with the central bank, and in deposits with them, which count as their liabilities. Now, however the government expenditure is paid for, it is still the case that there is a government deficit, budget deficit, what might call a borrowing requirement, which comes from the difference between government expenditure and what is received in terms of tax receipts. Now, the difference of government expenditure minus tax receipts has to be funded in some way, and that is done by the government, central government level, by changes in the bonds issued by the central government. And that in turn could be broken down into changes in the bonds held outside of the central bank, plus the change in central bank money. And the corresponding to that would be the government bonds which have been purchased by the central bank in one form or another. Now, I think the one part of this at the moment, and this is, I guess, some places where, in some sense, Geoff would want to depart from, is that both whether the expenditure minus tax is funded by bonds or by changes in central bank money, both of those would attract interest. On the bonds, the government pays interest on bonds. On any reserves held by the banks with the central bank are paid currently at the bank rate, so they're getting 4.5% on the reserves. So the quantitative easing which has taken place, and so the Bank of England now holding £800 billion, that corresponding to that are 800 billion reserves held by banks with the central bank, and that is paying them interest at 4.5%. So what's that, £36 billion? And in my view, one of the reasons why the banks are very profitable at the moment is because they're receiving so much payment from these interest payments from the Bank of England. So, and now this, I think, perhaps is the particular place where we're going to differ. It does, I think, the case that the Bank of England regards money which it has issued as debt or liability, and it pays interest on those banks' reserves with the central bank at the bank rate. So from the Bank of England's perspective, the liability of the money is matched by assets, often in the form of government bonds. Now, the other part of the argument is if the government is running a deficit because it is spending, in effect, more than it is receiving back in taxation, it will be funding that by bonds plus the money which has been issued by the central bank. But another relationship is that government expenditure minus tax revenue, the sectorial balance, some of the godly equations, I think, which Geoff referred to, is going to be equal to private savings minus private investment. I've done this for a closed economy, so I'm not considering imports and exports, which just to focus on the key issue. So if the government is running a deficit, then private savings have to exceed private investment. And in effect, the savings that people are making very indirectly are going to, also by corporations, are going to fund private investment, and they're also funding the government deficit. Now, in turn, what that means is that, well, just as an aside, because clearly interrelationships between the two sides. It's not to say that the amount of savings is going to be determining the amount of deficit or vice versa, because there's an interrelationship between them. So if, for example, there's a rise in investment, that gives rise to a rise in income, which will increase savings and increase tax revenue, and would tend to reduce the budget deficit. So how far can government expenditure rise, and how large can the budget deficit be? Essentially, it can go as far as to raise income and employment to full employment. If the government is spending more, that will push up, other things being equal, will tend to push up employment and keep pushing it up until you get to the full employment level. It's very difficult to calculate what that full employment level is. It also would be needed to have other conditions in place, like there is sufficient capacity in the economy to employ people. There's sufficient, yeah. So the maximum budget deficit is the savings at full employment minus investment at full employment. If you go past that, well, the way that I think Stephanie Kelton and others have put it, represented it, is that if you go past that point, inflation would result. I don't fully go along with that, I think, but it would still be that you would be pushing effectively pushing the economy past its full employment level. Now, as I say, it's quite difficult to define exactly what the full employment level is, and we can perhaps always argue that if you push a bit more, you get a bit more, but there's ultimately some, I think, some limit to that. So what I then, just to kind of summarize, is that if the government is, in effect, funding its budget deficit, the difference between government revenue and tax receipts by, let's say, sovereign money being issued, then that sovereign money would have to be held in the form of, savings by individuals. We would have to, so rather than paying taxes, we would be having to hold that money which is being issued as our savings. Now, at some point, we may be rather reluctant to do that. And so that, in a sense, kind of forms the limits. Now, there's another issue, which I'm going to sound a bit like Rachel Reeves if I'm not careful, I think. But if a UBI was funded to some degree by a continuing budget deficit, then the issue of sustainability arises. Now, the primary deficit is defined as government expenditure without interest payments minus tax revenue. The total deficit would include the interest payments. Now, if there's a continuing addition, sorry, if the budget deficit is going to continue, then it is adding to the debt or the outstanding assets, or whatever you might want to call it. And that eventually would continue to rise. It might stabilize at some very high level, but that would depend upon the relationship between the rate of interest and the rate of growth of the economy. So I think I'll stop there, because I think that's what I've got in the last part of the slide are some estimates of the costs of UBI, that is the financial costs, and I put them as per the order of 300 net of net at the order of 300 to 350 billion pounds, which is what, getting at 14–15% of GDP. And then you start working through, of course, the ways of paying for that, or raising the sufficient tax revenue, and you get relatively high rates of tax. And it would be through those rates of tax, whether on the UBI itself or on other forms, which would in effect be the transfer of income and wealth between from rich to poor, sort of thing. So that would be where the transfers would come from. So just to conclude, I would want to argue that one should approach looking at UBI in terms of raising tax revenues to offset the net increases in expenditure, and that as which is good. So I think back to the quote, which I think you have from John Kay, that if it's at any substantial level, it would involve relatively high levels of tax. I personally don't think those are intolerable levels, and they're not levels which are unaffordable or anything like that. But we, of course, would know what the political resistance to it would be. Thanks.
Okay, thank you, Malcolm, for your contribution. And so I saw there were some questions in the chat. I think Scott Baker asked some questions, and I wonder whether Scott would like to ask it directly, and rather than me asking on behalf. I don't know if I can unmute Scott. If you want to ask the questions, are you happy to do it?
Sure.
And say to whom, is it both speakers or just one?
I guess it's to Malcolm, because I had the most qualms with what he was presenting. In my understanding of sovereign money, basically that's produced by the government, and so you don't need taxes at all in order to acquire it. So therefore, you don't run a deficit because the money is just produced as money. So the issue of getting into more debt is not, it's moot. This doesn't happen. It's not part of the equation. So then the question is, how much money can you produce before you exceed the productive capacity of the economy to use up that money and without causing inflation, so that you don't stimulate excess demand, I guess. And there's various ways to control that, by maybe the output gap or some other economic mechanism. But I think the whole premise that you would exceed, or you would increase the debt by increasing the amount of money produced, if it's sovereign money, that just goes away if it's sovereign money. So that's my statement. I don't know if that's exactly a question, but that's my understanding.
Malcolm, do you want to respond?
Yes, well, I think the point is it doesn't go away. I mean, if the argument is that, well, let's take the extreme case where there's no taxes raised, and so the government expenditure is entirely financed and funded by sovereign money.
Well, in this case, for UBI.
Sorry?
For UBI, yes. Because that's what we're talking about today. We're talking about funding it with sovereign money. So,
yeah, well, but it could apply to almost anything else as well. But yeah, but then you need, but then effectively you need to do the calculation. How far can you push that to, in terms of the introduction of UBI? Now, my argument, I think, would be that one could increase government expenditure by 3, 4, 5%, something of that order, and that would get us to not exactly full employment, but it would get us to what the current capacity of the economy is. So after that, you have to have other policies of ensuring that the capacity of the economy is increased, if that's what you want to do, and to provide that. But I think my argument is that the extent to which you can use sovereign money or whatever, or money financed expenditure, how far you can push that is quite limited.
Well, I mean, I think just to respond a little bit, I think that depends on what state the economy is in, because, for example, when we had the great financial crisis, there was, according to Christine Romer, a $1.3 trillion gap between what was being output by the economy versus what potentially could be output by the economy. Now, Obama was allowed to do about half of that, and some of that was tax breaks in terms of stimulus, so we kind of limped along in recovery for many years instead of what she suggested, 1.3 trillion being stimulated into the economy. So that, in that case, that's basically the output gap. And that, at least in the United States, is measured every quarter, I believe. So that, and it's by the nonpartisan Congressional Budget Office. So that would be an indicator of how much could be produced without triggering inflation. So I think, you know, again, sovereign money is money produced by the sovereign without taxation, as far as my reading of it is understood. And I go back to United States notes, which, you know, came out in the Lincoln administration, 1862 through 63 and beyond. And so that was sovereign money that was never taxed for and was never repaid to banks or whatever. And it was in circulation, actually, officially until 1996. So we have a long history of having sovereign money without using taxes to pay for it. And, well, I mean, the amount was small relative to today, but at the time it doubled the federal budget during the Civil War. So it was a substantial increase. And although there were war-related inflation, that did not persist into the 1860s and 70s when greenbacks were kind of marginalized.
If I just go back to the financial crisis, I mean, I think a number of us here spent our time arguing that the budget deficit then was too small, and arguing against austerity and pushing it up. But I think the point is that where you can't wait for a financial crisis in order to introduce a UBI, because there are other times where when the economy is much closer towards to potential output. And I mean, some would argue currently it may be above potential output. It's not an argument I would go along with, but as we're taking the average position, if you like, then how far can you push the economy? And I would say that if you introduce UBI without any offsetting tax measures, that would push the economy way past full employment or potential output.
I don't know. I don't know if that's true.
Excuse me. Geoff, do you want to comment on this discussion? And because we don't want to have a sort of just a dialogue between two.
No, thanks, Reinhard. Well, I mean, in response to what Malcolm says, which, you know, I accept with respect. I mean, my worry is that we're reverting to an accounting view of economics. I was saying, well, look, we're going to spend 300 billion on basic income. We must fund that by 300 billion from tax revenues. That's accountancy, and, you know, there is a dynamic in the economy. And if you take effective demand out through tax increases, and then the effect of that on full employment outcome and so on is going to be severe. So you do need to run a macroeconomic model, not just an arithmetic exercise on funding one amount by another. The other is Malcolm's comment about full employment. Now, you know, I mean, full employment was the 20th century goal of economic policy, because we saw the depression in the 1930s. We never wanted it to happen again. So high wage full employment was the goal. My worry there, and I'm not saying I know everything about this or that I'm a guru on it, but my worry is that technology is reducing employment in the economy. And that's why we're seeing in-work poverty. That's why we're seeing low wages. That's why we're seeing this bifurcation of the labor market into extreme levels of inequality. In my view, okay, it may be driven by wicked capitalists exploiting labor, which is the view of some of my friends. But I actually think that some of it is an inevitability of the technology that we are currently deploying. And the third point is about the confusion between identities, post hoc identities, and behavioral equations. So, I mean, Malcolm again said that in that savings equal investment, that savings fund investment. That's certainly not the Keynes view. I mean, Keynes' view is that investment isn't funded by savings. On the contrary, it's promoted by expected consumption. And the identity of savings and investment is post hoc. So I just wrap up by saying, I mean, I played this presentation to the internal research group of the Bank of England, and I expected quite a lot of hostile response. Actually, at the end of the presentation, they said, Geoff, we agree with everything you said. So there is a shift in paradigm thinking about what money is. Is it necessarily debt? So if you take the present £2.3 trillion worth of debt, national debt in the UK economy, my question would be, retrospectively, if at the point that debt was taken out, the same money was expended in the economy for hospitals, nurse pay, bridges, whatever it was, but it had not been accounted as debt, what would be the difference in the present economy? So, you know, I think it's screaming for a paradigm change, and we've got to think our way through it carefully.
Okay, thanks. I suggest we don't have I mean, we probably have to agree sometimes to disagree and just raise our opinions. I would like to ask Rick Salbro, who has had 2 questions, to unmute you, and you can ask him, but try to be as short as possible. So, and raise your questions, Rick Salbro. Can you? Yes, you're unmuted now.
Thank you. It's to do with this statement apparently by John Kay that small UBI would be meaningless. The first point is that when we saw the £20 uplift to universal credit, it really mattered to a lot of people. And therefore, it seems to me, my first question is, we could start fairly small to get the public used to the idea of UBI. It wouldn't make much difference to professors of economics or people at the Bank of England, but it would start to make a difference to the people who are suffering from the current economic situation. So that's one part. But the other part, which relates to Geoff's presentation, is that if we take back to the government a right to issue money, surely we're going to have to take it away from the banks, which is what they do at the moment. And then they'll have to go back to that famous guy in Burnley, who is a savings and loans, or a credit union or something, which does happen, but it's not where they make most of their profits. And of course, there'll be a massive pushback against that. So I'd just like to know some ideas about whether that's the way to do it, or if it is, how to do it in the face of opposition. So
this question is addressed, I suppose, to Geoff. Is it correct?
Mainly, yes, but it'll be interesting.
Thank you for that. I mean,
okay, and then maybe Malcolm here. Please go ahead, Geoff.
Yeah, I agree with the first point you made, that it should be introduced gradually and increased. And in my meeting with Stuart Lansley yesterday, I mean, he has been constantly putting revenue neutral models forward, and I've been putting more radical models forward. We agreed that there's an evolution from one to the other. So I'm fully supportive of Stuart's view that we can start with the basic income, which is revenue neutral. On your second, and then, you know, it's a test, it's a proof of concept. It can then evolve. On your second point, I disagree with Joseph Hoover, actually. I like very much, we get on very well, but I would still allow commercial banks to create money for loans to individuals and to businesses. Because in Switzerland, when they had the referendum, the National Bank of Switzerland didn't want to have the monopoly of creating money for individual loans and for business loans, because they said it didn't have the infrastructure or the expertise. So I'd leave that actually with the commercial banks. What I want to see is that the government should be able to create money instead of having to borrow it by the issue of bonds.
Yeah, okay, thank you, Geoff. Malcolm, do you want to say something regarding this question from Richard?
Firstly, on the last point that Geoff made, I think one of the problems with digital money operated only by the central bank is how a loan is going to be provided. And I think he hinted at, or more than hinted at that, which is that the Bank of England or central bank would then have to take over the making of loans to individuals. And also and this maybe relates to another point which Geoff made, is that one of the interesting, particularly post-Keynesians would say, is that money by banks has to be created in order to allow investment to proceed. And if the banks are not providing those loans, then the expansion of investment will not be able to take place. So let me just go back to a couple of points which Geoff made. Firstly, I'm not dealing in accounting identities. I realised the difference between ex ante and ex post, and I did hint at such relationships. Another point is that you said, ask the question, I think, of what would happen if all the debt was abolished. Well, one of the things which is often forgotten is that what is the national debt is public assets. My pension is being paid by the bonds which the pension funds hold. So, and one of I think the other part which comes out of the sort of stock flow consistent modelling is that assets and liabilities have to correspond to one another, as it were. One person's assets, another person's liabilities, and so what we call the national debt is not the national debt; it's the debt of the government, and on the other side is there are assets of the public. I think that was all. Yeah. Oh, the other. If I indicated that savings preceded investment, that was certainly not a point I want to make. But investment precedes savings, and it has to. But investment has to be financed in order to take place, and then ex post, there is a correspondence between savings and investment.
Okay, thanks, Malcolm. Let's give Peter now a chance to ask his question. And Peter, please go ahead and just say whom you want to address it to. Thank you.
Oh, I could address it to both panelists. But frankly, it isn't the mechanics of the debt-free sovereign money that the central bank either issues debit cards to individuals or central bank debit cards or deposits them in their personal bank accounts. And then if there's excess demand, then some kind of taxation will be necessary. And there are many options. I prefer a highly progressive income tax, but if there's excess demand, isn't this the proper mechanics of this to just simplify matters?
Yeah, I agree.
Geoff, you agree? Okay, that's a short and quick answer. Malcolm, what is your answer?
Yeah, I think yes. The government spends, and how much of that money that it is spent into the economy should remain. We have to look at demand side and how much comes back through. How much should come back through tax revenue, and we should try to arrange that so that we get to the highest level of sustainable employment.
Okay, thank you, Malcolm. That was quick. Are you happy, Peter?
Fine.
Okay,
but I don't know what all the problem is then. Why is there such a debate between these two gentlemen?
Okay, let's come to this at the end. Now I ask Mark, Brian. Mark, please go ahead with your question and say to whom you want to address it.
So this is basically addressed to Geoff, and I've actually put it in the chat, so I'll just basically read it. So first, just a comment. You gave that example of the £100 billion that had been modelled, the injection into the economy. If you do the sums, and it's distributed equally across the population, it's £30 a week per person. So that's obviously a small UBI. I don't have a problem with that, but I think, realistically, is that the sort of magnitude we're talking about? First, so that's my first question.
Yeah.
The second thing, in the scenario when you wanted to put a higher sum into the economy, you said you'd match that by an equivalent withdrawal of labour. That seems like a very mechanistic kind of thought experiment. What's actually the process by which there would be a withdrawal of labour, given that currently we have almost record employment levels? So it's it's not like employment's dropping by itself, notwithstanding COVID.
Yeah, well, no, there's fine questions. I mean, the 100 billion that was put into the Cambridge econometrics model was testing concept and was proof of concept. So it wasn't an intention that that would be the actual amount of a proposal of UBI. We were keen to test what the effect of a reasonable amount of basic income funded by debt-free sovereign money would be. And specifically, would it collapse into hyperinflation or to devaluation? So, I mean, it was an exercise which was fairly expensive, and the limits of the research were that. So I agree with you. I mean, that doesn't necessarily translate into what the proposal for a political policy for UBI at that level would be. It was testing of concept and proof of concept. And sorry, your second point was?
The withdrawal of labor, I think.
Oh, yeah. Yeah, well, so the second part of the simulation was, it did a very, very rough cut analysis based upon some of the recent studies that have been trying to estimate how much employment would be lost through automation over the next 10, 15 years. So we just took 15% because it's kind of within range of what those forecasts can tend to look like, and took 15% out of labor income, because the assumption behind that was that technology will continue to suck labor income out of the economy. And indeed, the project that we've run at the Institute for Policy Research at the University of Bath analysed 23 countries' economies and did demonstrate that technology is reducing the labour share in the economy. You automate the whole of London Underground, there's suddenly no ticket collectors or anything else or officers left there. Technology is reducing the labour content of output. So we modelled, that's one of the arguments that I would forward for a basic income. So therefore, just take 15% out. I agree, very crude, but then run it through this pretty sophisticated model and see if that technological unemployment assumption would still yield, through the basic income replacement and funded by debt-free sovereign money, would still yield a stable equilibrium. The answer was that it does.
Okay. I guess the question is that if the labour share is falling, the capital share is increasing. So shouldn't we be taxing the capital share and using that as for the UBI rather than putting new money in?
Yeah, I mean, I don't know is the answer to that. I mean, as I said at the beginning, I can't pretend to know everything, so I don't know. I mean, there are various different analyses that we could try, but obviously this research is fairly costly. You're talking about 60K per shot with a project like Cambridge Econometrics or whatever. So we get to a limit of resourcing the research that we want to do. So I don't know, but my concern is that, well, for example, if you get 100% automation in the economy, you'd need to get income to people. And currently, we desperately need to get income to people. Whether, as you say, we can do that by taxing capital and how that would work, I'm very cautious about the wealth tax proposal. I just don't see how you can convert a stock into a flow. Wealth is a stock and income is a flow. If you take the Quant family who own BMW, for example, and we tax them, could they give the government one of their BMW factories or something or other? What do you do with real assets? So I'm obviously keen to explore, and what I have been doing is to explore this idea that money should be debt-free at the sovereign level. And I can only, in a sense, really answer what we've tried to do with that. I admit inadequacy to totally answer your question as to whether capital could be adequately taxed to make the gap up. I don't know, but I would maybe throw that back to you to demonstrate, really.
Okay. Malcolm, do you want to say anything about this discussion, or you're...
Well, in a sense, if something becomes fully automated, then you've either got to find some way of distributing what is produced to be free of charge, or if you're able to sell it, then that's going to yield effectively profits to the automated company. But unless those profits are in some sense distributed, there'll be nobody wanting to buy effectively the products which they're producing. So there's got to be some way of, if you want to retain something like full full employment or full utilization of, as it were, redistributing income to people who are going to spend it. I mean, in a way, it's a problem which stretches back 200 or 300 years. That is the idea that if income is shifted between from wages to profits, there'll be an inadequacy of demand in the economy because, and this, I think, if it's in cases of automation, that would be that issue writ large. So there would have to be some way of enabling people to buy what these automated factories are producing.
Yeah, but Malcolm, I'm proposing my thought experiment. That's done by a voucher economy. Vouchers are just given to people to be able to claim their goods and services. So my thought back to that would be, wouldn't this approach a sort of Sraffian economy, i.e. the production of commodities by means of commodities? Because as you know, Sraffa tried to show you could have a zero profit economy, or Leontiev, we're moving away from the concept of profit in the economy. We're just producing goods and services and distributing them by a voucher.
Okay.
Yes, you could distribute them by voucher. So what's produced is allocated to people via vouchers.
Yeah.
And there's no cost of production, presumably. And
yeah.
Okay. I have got, I think Susan Lee, she doesn't respond, so I asked the questions for her. She puts them in the chat. How would the government decide how much to create sovereign money? How would the government decide how much to let loose via UBI rather than other spending? Is there any answer to this at the moment? I mean, obviously, she wants to know how much sovereign money should be created and how would the government decide about it, and how much of this sovereign money would be used for UBI, because obviously there are also services, as we assume we don't want to abandon all sort of services like health, education, and so on. Malcolm, have you got not Malcolm, Geoff, have you got a response to these two questions?
Well, theoretically, my response would be that you'd issue as much basic income as proportionately to the proportion of output that was produced by automation in the economy. But my sort of practical steps towards that would be that you'd simply not call the present level of deficit increase deficit or debt. You'd simply issue that as sovereign money. So that's a rather conceptual answer rather than a practical one. But yeah, we've been trying to work towards quantification by the research projects that I've outlined.
Okay. And how much would be sort of used for sovereign money? Is there any way to decide for UBI of the sovereign money? How much of the sovereign money would be used for UBI?
Pass.
I mean, you can say I don't know, so it's fine.
Yeah, I don't know. Yeah, I mean,
okay.
We have to model that. But actually, this forthcoming run with the stockflow consistent model will give us more answers to that, because it does include a specific financial sector. So we'll be able to see where the financial balances are and where the financial flows are. So that will give us a better handle to be able to try to answer that kind of, it's a very relevant question, but like others, I don't necessarily have an immediate answer. We're working towards it.
Susan, now I can see you are unmuted. You asked earlier on also a question about the scandal. Do you want to raise this question?
Hi, sorry, I have very bad signal, so
okay.
For me.
Okay, so she earlier on raised also the question, Geoff, you spoke about this scandal that the government sort of has debts and then it's bought by the Bank of England. So can you explain this scandal, what you see is as a scandal about it?
Yeah, I think it's a total scandal. So currently the rules are, these of course are very arbitrary rules. They're an artifact we've loaded on ourselves. Currently, through the Debt Management Office, the government sells bonds only to those who have a license to trade in the primary market, which is pension funds, insurance companies, stockbrokers, rich individuals, foreign central banks. Then, when the Bank of England wants to buy government bonds or is instructed by the government to do so, it's not allowed to enter into the primary market. It can only buy in the secondary market, i.e. from those same pension funds, insurance companies, stockbrokers, and so on. And in my view, 875 billion has passed through that chain. And there is a percentage margin on that 875 billion that's gone to these intermediaries at zero risk. Now, I had lunch a couple of months ago with Chris Giles, the FT journalist, who said to me, "Oh, Geoff," he said, "it's not a very big percent they make." I said, "Chris, you don't need a very big percent on 875 billion, do you?" And actually, I've been touting around trying to find a journalist to help sort of expose this scandal with a big scoop. And they all back off. So whether they've all got shares in the primary market intermediaries, I don't know. But you see, the other issue about pension funds is that pension funds have been forced to increase the percentage of their portfolio, which is held in government bonds, from about 30% up to about 70%, because they've been required to fund government expenditure. And that recently, as you all probably know, got to the extreme that the pension funds then had to hedge their bond holdings through these LDI contracts. The LDI contracts called for cash, and the pension funds in some cases nearly went bust. So if the pension funds were not required to buy so many government bonds because the government didn't sell the bonds, it just issued the sovereign money, then the pension funds could use their balances to buy equities and fund real industry, which is what they're also being called upon to do. So in my view, this radical paradigm where we're trying to create does actually answer a lot of the questions. But the trouble is, as soon as you try to offer a suggestion to the orthodox thinkers like Martin Wolf and Paul Johnson and Acemoglu and all the rest of them, they immediately try to trash the radical thought, because it wasn't what they learned at university, or this isn't what they've practiced their whole career doing. So it is difficult, as Keynes said, it's difficult to get new ideas accepted. And Max Planck famously said, scientific theory changes one funeral at a time. You have to wait for a kind of new generation of thought to work through.
Okay, Malcolm, do you have got some suggestions or comments on these radical thoughts? What, with pension funds?
Not specifically. I got a lot of criticisms about quantitative easing and what it's done and the way it was operated, but that's probably coming from a somewhat different, not exactly different direction, but raises some different issues. So I think quantitative easing has been a bit of a failure and created all sorts of problems. But essentially, there's the central bank and the financial institution, the whole monetary system operates in the interest of the financial institution. So yeah, it's going to be arranged in a way which is advantageous for them.
Yeah. Which is why my proposal would knock them out. You see, if you ultimately knocked out the bond market and it didn't exist, and all government funding, because I'm talking in extremis here, then the financialization would be reduced, and all the stockbroker fraternity would be terribly against it, which of course they currently are. And it's through that orthodoxy that this idea is being resisted. But I repeat, I think it is a huge scandal that the Bank of England is going into the secondary market and benefiting all these holders in the primary market and not allowed to participate in the primary market itself. I just think that's scandalous, and I've heard no counter argument to my accusation of scandal.
Okay, at the moment, okay, there was one from Iago Mendes. Do you want to ask the question? I try. Iago Mendes, do you want to ask the question? Yes. So Iago is asking, for modern monetary theory, it's not a problem for the government to have a deficit on its own currency. However, to finance a program such as UBI, it is expected for the government to have a permanent deficit due to the high cost of the program. This permanent deficit could be a problem due to external restrictions. Any comment?
Well, can I first say, governments always run deficits pretty well. I think in the case of the UK, it's run a surplus in 5 years out of the last 50 or something like that.
Yeah.
So deficits are the usual procedure. And I suppose just to make the point I made before, is it where I think deficits should be used as far as as possible to generate the highest sustainable level of full employment. So, and that should be the way the deficits are used. And that to me is the socially responsible actions. And so, which particular programs it includes is obviously a matter for political debate, and how yeah. So I think that's probably the major point I would want to make. I would say on MMT, they are sort of rather behind the game, because you can find authors in 1943, 1944 arguing precisely that governments should run deficits in order to sustain full employment. And the argument I was putting, that the maximum deficit they can run is that to achieve full employment. So the idea of running deficits is nothing new.
Yeah, I mean, I partially agree, Malcolm, but I think we should shift the emphasis from employment to income. Well, because I think technology is threatening employment, and we've got to preserve people's income. So I think the emphasis should shift. And I'd suggest that, of course, employment has other benefits than income. I understand, role and identity and networking and all those kinds of things. And therefore, we may have to reinvent ourselves to some degree, that my identity is not derived from what factory or office I turn up to, but it's something more fundamentally to who I am with my fellow human beings. But on the MMT question, yeah, I mean, MMT does say that a government can raise deficit in its own currency, which it clearly can. And MMT doesn't worry about the deficit because it sees it being matched by other balanced surpluses in the economy, as I said earlier, in the personal private sector and in the overseas trade sector. Now, all that's right, but as I pointed out to Stephanie Kelton, that is only right, again, post hoc. That's a post hoc identity. And the idea that they push, that you can add 100 billion to your government deficit, wow, by magic, this will add 100 billion surplus to your private sector, is just not true. Because what will happen, of course, your 100 billion in basic income or whatever will then work through the economy, will come to another position where those identities still hold, but at a different level. And the MMT view that the identity holds at the same level, that's what I would dispute with them, but they're not really up for discussion, MMT.
Okay. I mean, there are no other questions at the moment. I just want to raise one quick question. I mean, I had lots, but I mean, about employment and profitability. I mean, I seem to get the impression as a non-economist, there's an enormous profitability in the technology sector, but the profits are not redirected to the social sectors because there's an enormous need for employment and work. So in education, in social care, in healthcare, we need more staff, but that doesn't seem to be the money to employ the staff. So is sovereign money the answer, or is the answer to really tax these companies effectively so that the money is redirected to the social sector? That's my question for both Geoff and Malcolm. Did you understand my question? Is it clear?
Yeah. I've got no problem with taxing excess income. So, I mean, and that's my comment about land tax, that it wouldn't address the huge profits being earned by, Meta, by Netflix, by Google, and all the rest of them. So I'm all in favor of higher tax for them. Whether that's the entire solution, I'm less sure.
Okay. Malcolm, any comment on your side?
Well, I think part of it is political priorities in terms of why don't we spend more on social care? Well, we want to spend it. We want to spend it on military. There's setting the political priorities. So in some sense, you have to set the political priorities first, or agitate for the political priorities. Yeah. Then we have to work out the what are the implications of that in terms of what would it do for what taxes would be needed. Again, I guess in Geoff's case, what issue of sovereign money would be required, but we have to start from the political priorities and get those sorted first. And I think after that quote from Keynes, isn't it? We can do anything. We can afford anything for which there is the resources, in effect. So the limit on say social care is I suppose coming from, well, a preference to buy Trident missiles rather than invest in social care. Putting it in rather extreme form, but
okay. So yes, I mean,
And Mark and
Yes.
Co have made the comment that we do have a blip in the labour market. I personally think that it's a significant blip, but still a short-term blip. It's come out of COVID, where a number of people who went under furlough decided to withdraw from the labour market. How long they'll keep that up for is a question. And because of Brexit, so there's not a free movement of labour in the UK anymore. So, there's definitely a crisis in social care employment and in agricultural fruit picking employment and so on and so forth. So there's apparently a shortage of labour. I personally think that's a blip, and that the technology will still keep on reducing the working hours a week as it's done for the last 100 years.
Okay, I think we have reached now 8 o'clock, and I think we should not put too much demand on the time. I think, as I always say, time is our most valuable resource, and therefore it should be supported by basic income. So I suggest I don't give a summary because as a non-economist, but I hope we all learned, and I think it's a very interesting issue. Is it taxation or is it sovereign money? But we need to have a good way forward. And I would like to thank especially Geoff and Malcolm for their contributions, but everybody for their interesting questions. And I would like to say that this discussion and presentations will be available, will be uploaded to the UBI Lab Network YouTube channel, so you can see it there. And you can also, I think the presentations will be made available at the same time because it was asked to have the presentations. They will be also made available thanks to our famous technical support from Johnny Douglas. And yes, I would like to wish everybody a good evening and thank you very much for attending. And I hope it was useful, and we will try to find further topics related to the funding of basic income in the future. So thanks a lot. Have a good evening, and yes, enjoy the summer and hope to see you soon again. And Johnny also said, if you want, you can join UBI Lab Network and support it. You find a sort of link in the chat. Thank you. And bye-bye.
Bye.
Thank you all.
Bye.